My name is Dave Wilhelm. I am an associate professor in the Business Administration Department at Wake Technical Community College in Raleigh, North Carolina. This video is one in a series that tries to ensure that my online students get the same information as my seated students. This particular video talks about determining the viability of a project using the payback method. Let's talk about the payback method.
And let's discuss payback. The topics we'll cover are, we'll look at the various financial return methods, some oversimplified payback examples, and some additional considerations that one may want to take into consideration when applying the payback evaluation method to a project. Project financial analysis methods. Internal rate of return is pretty much a finance and accounting specialty. I've heard of it, but that's about all I know about it. Net present value generally looks at making an investment or a string of investments and looking at the corresponding incomes as a result of those investments. It considers the time value of money, uses a discount rate. The discount rate generally includes the interest rate as well as perhaps some risk rate thrown in there as well. Looks at the outlays and inlays forever, although at the end of a period of time, the discount rate is going to make things in the far future not that significant. Payback is actually the simplest method, and this is what we will be looking at today. The time value of money is ignored, and it just looks at the outlays and inlays for a limited period of time, and that period of time is when the investment is recouped. The characteristics of all of these are cash or the equivalent should be used for the evaluation. Keep in mind, future benefits are estimates. They are guesses. The costs may be actual or estimates. Today's costs or actual costs in a year or two are going to be estimates. The precision values, precision varies. Internal rate of return, if applied properly and with good estimates, can be quite accurate. Net present value is in the middle. And finally, payback is the simplest and least precise method. All of these, the model for all of these is that there is a single investment or string of investments and then a string of returns. It is not an ongoing situation like break-even analysis where we have ongoing fixed costs, variable costs, and sales prices. The inputs for payback are today's cash or equivalent acquisition cost. How much does it cost to get whatever this thing is? The cash benefits estimates till the investment is recouped. And we ignore the time value of money. So cash benefit in 2 years is not discounted as it would be in net present value. The goal or the result that we're looking for is the number of years to recoup our investment. The use of this result is many companies have a requirement that for a project to be approved, the payback period must be 2 years or 3 years or 4 years, certainly not more than 5 years. So if the project payback time is less than that requirement, maybe the project is approved. If, and typically there are lots of other projects that people would like to pursue, in that case, if our project payback time is less than enough other project payback times, perhaps we will be approved. Here is an oversimplified example. A piece of capital equipment costs $35,000, cash or cash equivalent, and as a result of this purchase, the company, we estimate, will save $7,000 after taxes annually forever. Determine the payback period. The time for payback is equal to the cost divided by the savings per year. That's equal to the $35,000 one-time investment divided by $7,000 per year. That simply equals to 5 years. We then look at the company's requirement and the other projects to determine if this is a go. Another somewhat oversimplified example, a piece of capital equipment, again, costs $35,000. As a result of the purchase, the company saves the after-tax amounts indicated in the table below. Determine the payback period. And all we have to do for this is simply count up the after-tax savings amounts until they equal or exceed the cost of the capital equipment. After 1 year, we've saved $9,000. After 2 years, $9,000 plus $8,000, $17,000. After 3 years, $24,000. 4 years, $30,000. 5 years, $35,000. Bingo. So the payback period is 5 years. If it did not come out evenly like this, we would simply estimate it. Depending on what the practice at the company is, we would round up, round down, or maybe use fractional years. Last oversimplified example, piece of capital equipment costs $35,000. And as in the previous example, the company saves the after-tax amounts indicated in this table. Determine the payback period. After year 1, we've saved $7,000. Year 2, $13,000. Year 3, $5,000. Year 4, $22,000. $25,000. $27,000. $28,000. Our estimate was no savings during year 8 and afterwards. So in this case, we never did come up with the cost of acquisition, so the return on this investment would be less than the investment, so we don't do it. Comments on the asset acquisition. If it's a one-time cash payment, the outlay is simply the acquisition cost. If we're borrowing, we can add the sum of the principal and interest payments, and depending on the precision we are after, we can ignore or account for the time value of money on the asset acquisition side only. The time value of money, only apply it to the acquisition cost, not the benefit cost. If we apply the time value of money to the benefits, there's nothing wrong with it, but then we're doing net present value, which is a little more involved rather than doing payback period analysis. Do include grants, tax credits, any other offsets to the cost of the asset. The benefits, well, whatever benefits we get, whether it's a cost reduction or a revenue increase, is going to be taxed. So we do need to reduce any increased earnings or decreased expenses by tax. So if we have a benefit of $10,000 earnings before taxes, by the time we take 25% tax, that's actually a $7,500 benefit. Depreciation is a non-cash expense that reduces taxes. This is a small benefit. Again, remember, we're working with estimates. So depreciation will be a percentage of the cost and the percentage by tax. Interest on the acquisition cost, if money is borrowed, again, is going to be a very small benefit. The percent interest and the percent of tax. There's a very good question of how precise our calculations can be or try to be. They're based on estimates. Here is a real-life example of the city of Raleigh, North Carolina. They determined that they could save $53,000 a year by going to some automatic garbage and recycling can combinations. So their annual savings is $53,000. Their one-time cost for 37 of these units was $6,000 times 37, or $222,000. The payback period was $222,000 divided by 53,000, or 4.2 years. However, there was a kicker. The cost to Raleigh was only $72,000 because they received a $150,000 grant from I'm not sure where. So that Raleigh's payback period was $72,000 divided by $53,000, or 1.4 years. And that's it for payback.
That's it for our discussion of using the payback method to determine the viability of a project. If you have any questions or comments, send me an email, and please put payback in the subject line.